Hello everyone, I'm Divya Grover, here to help you take informed mutual fund investment decisions. Indian investors love to talk about mutual funds. Which ones to buy, which categories are hot, which fund manager has the Midas touch, and more. Coffee table conversations, WhatsApp groups, and television debates usually revolve around one thing: what to invest in next. What rarely gets the same airtime is the harder question: when to sell. Buying feels exciting, a new bet, a new beginning. Selling, on the other hand, feels like pulling the plug. Some avoid it altogether, while others sell too often, pulling money out at the first sign of trouble. Yet, exits matter more than entries. Remember that a great fund bought at the right time can still disappoint if you panic sell during a market crash. A mediocre fund can still deliver if you exit sensibly. So, why frequent selling of mutual funds should be avoided? If your time horizon to financial goal is at least 5 years away, short-term market movement in the equity market should not affect their investment decisions. For such investors, staying invested in equity mutual funds, regardless of market conditions, allows their investment to grow and compound wealth and thereby takes them nearer to their envisioned financial goals. On the other hand, if investors redeem their equity mutual funds only to re-enter at a lower level later, they may miss out on future gains. This can create a hurdle in their wealth creation process. Timing the market in the case of mutual funds is futile, especially for those investing for the long term. No one can accurately predict if the market has bottomed out after a correction or whether it will keep rising after reaching a peak. So there is a high probability that the investors' bets may not pay off as expected. Thus, the answer to when is the right time to sell your equity mutual funds may vary for every individual investor based on their investment objectives. Ideally, investors may consider selling their investments only under the following circumstances. Number 1, when the goal is nearing. If the goals for which investors have invested is less than 3 years away, it is time to gradually trim allocation in equity funds and shift to less risky avenues such as safely managed debt funds and or bank deposits. This will protect the corpus from any potential sharp corrections at the end of the goal period. Number 2 is when investors have achieved the desired corpus. Investors who have been investing regularly through market highs and lows would have likely accumulated a sizable amount over a period and fulfilled their goals. Such investors may consider booking profits to protect the capital from market uncertainties and volatility. Number 3 is change in fundamental attributes of the mutual fund scheme. At times, the fundamental attributes of a scheme may undergo changes, such as a change in control at the AMC level, change in investment philosophy, strategy, or style of the fund, or change in scheme category, etc. Such changes can result in the scheme following a more aggressive or conservative approach and may no longer be in congruence with the investor's risk profile and investment objective. In such a case, investors may consider selling their mutual fund units and invest in a scheme that aligns with their investment objective. Number 4 is consistent underperformance of the mutual fund scheme. At the time of periodic portfolio review, it is important to compare the performance of a mutual fund scheme with its peers and the benchmark. If the mutual fund scheme that the investors have invested in has consistently underperformed most of its peers and the benchmark across various market phases, then it may be time to redeem it and replace it with a better alternative. Do note that the underperformance in the short term should not be a reason to sell a mutual fund, as the performance may improve in the future. Number 5 is financial emergency. In case of a financial emergency or an unexpected rise in major expenses, investors may consider selling their equity mutual fund units as they are highly liquid. However, selling mutual funds should be seen as a last resort, and investors may first consider utilizing the corpus parked in the form of an emergency fund. Number 6 is change in personal circumstances. An individual's personal circumstances may undergo changes over the years. This may result in change in priorities, which may induce investors to revisit their existing financial goals and investment approach. For instance, investors in their 20s may be willing to take high risk, but they may be satisfied with safer avenues in their 40s. If the new financial goals warrant a more aggressive or conservative approach, then investors may consider selling a mutual fund and replace them with a suitable alternative. Number 7 is rebalancing. Sharp movements in the equity market often lead to deviation in the investment portfolio from the set asset allocation. For instance, during a bull run, the equity allocation in the portfolio can breach the set limit, say it reaches 85% from the target allocation of 75%, and thereby make the portfolio riskier. In such a case, investors may consider trimming the allocation by selling a portion of their investment to bring it back to the original level. In conclusion, investors should avoid knee-jerk reactions during market highs and lows. Market volatility is an inevitable part of investing, and reacting impulsively to short term fluctuations often does more harm than good. Thus, long term investors should focus on their broader investment strategy, staying disciplined, and maintaining diversified portfolios. For more guidance on mutual fund investments, subscribe to Equitymaster's YouTube channel. If you like this video, please give a thumbs up and share it with your friends and relatives. Signing off for now. Happy investing. Mutual fund investments are subject to market risk. Read all scheme related documents carefully. Registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.